Okay, let's crack open the latest results from Arvind Fashions Ltd AFL, one of India's, biggest casual and denim players.
We've got their Q2 FY26 results here. Press releases, investor decks, all dropped November 3rd, 2025. It covers the quarter ending September 30th.
Exactly, and there's a lot here. So our mission today, I think, is to look beyond just the headline growth.
Right. We need to dig into the how. The reports raise this big question. How did they boost their profitability so much, especially right now?
Yeah, because the top line is, well, it's solid. Revenue up 11.3% for Q2.
Which is decent, definitely.
But the real story seems to be what happened after those sales, their EBITDA.
Yeah, the core operating profit.
That grew way faster, 18.2%.
That's the gap we need to explore. When profit outpaces revenue by, what, almost 7 points?
Yeah.
Something strategic is clearly working well.
That margin expansion, that's got to be the focus of this deep dive.
Absolutely. How did they pull off that kind of discipline and, frankly, that profit boost in what everyone agrees is a tough, competitive market?
And the answer seems to be hiding in plain sight in these documents.
It points strongly toward their big shift, pushing hard on direct-to-consumer channels.
Okay, let's unpack that. But first, let's ground ourselves in the actual numbers, the pure financials. Q2 FY26 consolidated, compared to last year.
Lay them out.
Revenue hit Rs 1,418 crores. That's the 11.3% jump year on year, up from Rs 1,273 crores.
So solid double-digit growth, pretty good in this consumer climate.
But like we said, the profitability stuff is maybe more revealing.
That's where it gets really interesting. EBITDA climbed to Rs 200 crores. That's the big 18.2% jump from Rs 170 crores last year.
And the margin itself?
That improved too. EBITDA margin went up by 80 basis points, now sitting at 14.1%.
Okay, hold on. For listeners maybe not deep in finance speak, basis points, or BPS, 80 BP sounds small, but what does it mean practically?
Great point. Yeah, easy to gloss over. 1 basis point is just 1/100%. So 80 BPs means their operating profit margin grew by 0.8%. And while 0.8% might not sound like a lot, on revenues over 1,000 crores, that translates to, tens of crores more profit. It really signals strong cost control, pricing power maybe.
And that discipline, it seems, went straight to the bottom line. The profit after tax, petty T from their continuing business, jumped nearly 27%, rose to Rs 38 crores from 30 crores.
Wow, okay. That's significant follow-through.
And just to show it wasn't a one-off good quarter, the half-year numbers, H1 FY26, they back this up.
Right, the first 6 months.
Revenue's up 13.3% for the half year, and PAT from continuing business up a huge 63.6%.
Okay, so definitely sustained momentum. It's not just a Q2 blip. There's a real trajectory here.
But you mentioned something earlier that explains a lot of this.
Yes. The crucial number, I think, in the whole investor deck, it's the gross margin.
Okay.
It expanded by a massive 210 basis points. Hit 52.5%. That's the real engine behind the EBITDA improvement.
Whoa, 210 BPs. That's way more than the 80 BPs jump in EBITDA margin. Why such a huge leap there?
Well, they actually tell us directly in the presentation. They pin it on 2 key things.
Which are?
1, a richer channel mix, and 2, maybe even more importantly, lower consumer discounting.
Okay, so that's the strategy playing out.
Exactly. Sell more through higher margin channels. That's the mix shift. And crucially, hold the line on price. Don't just slash prices to move stock. That's the reduced discounting. They're controlling the price story.
So if the numbers tell us what happened, higher margins, higher profit, then this strategic shift to direct channels tells us how.
Precisely. Let's pivot to that now.
Yep.
Section 2, the direct channel strategy. Because this seems to be the powerhouse driving that high margin growth.
Makes sense. Traditionally, big brands like this rely a lot on wholesale, right? Selling to department stores, other retailers.
Yeah, exactly. Wholesale gets you volume, scale, maybe, but you sacrifice margin and, critically, control over the brand experience and pricing. AFL seems to be deliberately moving away from being too reliant on that.
And you can see it clearly in their channel performance breakdown, their own physical retail stores.
Yeah. The EBOs, exclusive brand outlets.
Yeah, those grew about 14%. And importantly, their like-to-like growth, LTL, was strong at 8.3%.
And LTL is key, isn't it? It strips out the effect of just opening new stores. It tells you how well the existing stores are performing. 8.3% is pretty healthy, shows good execution in their physical footprint.
But the real explosion seems to be online. Their online B2C, that's their own direct-to-consumer website and platform,
Yes.
grew by over 50% year over year.
50%. That's not just growth, that's acceleration. It really validates that strategic focus, doesn't it?
Totally. And it changes the whole shape of the business. If you look at the channel mix they reported, comparing Q2 this year to last year,
What's the shift look like?
retail share, the EBOs, went from 33% of revenue up to 38%. And online B2C, that direct channel, jumped from 8% up to 12%.
Okay, so add those up. That's a 9 percentage point swing in total revenue, moving away from lower margin wholesale and maybe online marketplaces
Right?
and moving into their own higher margin direct channels. That's huge.
And the reasoning they give. It connects right back. They say they're focusing on direct channels for, quote, better inventory control and building stronger consumer connections.
Which makes perfect sense. If you control the inventory directly, you control the pricing. You're not forced into huge end-of-season sales just because a wholesale partner is overstocked.
So you avoid eroding that gross margin.
Exactly. It ties directly back to that 210 basis point improvement we saw. They're essentially capturing the margin that used to go to the middleman.
And we should probably mention the brands they're doing this with. It's a powerful portfolio.
Oh, absolutely. AFL is the #1 casual and denim player in India. You've got the big international names, U.S. Polo Asson, Tommy Hilfiger, Calvin Klein.
Plus strong homegrown brands like Arrow and Flying Machine.
And they're not just sticking to the core stuff either. The presentation mentions adjacent categories.
Things beyond denim and core casuals.
Yeah, accessories, maybe other apparel types. Those grew at over 20%. So they're leveraging the brand strength to sell more kinds of products to the same customer, broadening the basket.
That brand strength is vital because scaling this direct strategy needs really tight operations. Which brings us nicely to Section 3, strategic outlook and operational discipline.
Right, you can have a great strategy, but execution is everything, especially with growth.
And growth needs funding. But AFL seems to be tackling its retail expansion smartly. They're aiming for, what, about 150 growth store openings this fiscal year?
Yeah, about 150, which sounds like a lot of capital outlay.
But they're mostly using an asset-light approach, aren't they?
Correct. The FOFO model. Franchise-owned, franchise-operated. This is really important for their finances.
How does that work exactly?
Essentially, a local entrepreneur, the franchisee, puts up the money to build and run the store. AFL provides the brand, the product, the systems, the marketing support.
So AFL gets the brand presence, the distribution point.
Without having to spend their own cash on building the store itself. It lets them expand much faster without draining their balance sheet.
It's like outsourcing the capital cost and the day-to-day store management, allowing them to focus on the brand and the product.
Pretty much. And you see this scale already. They ended Q2 with 998 of these exclusive brand outlets after adding 24 in the quarter. That FO&FO model is key to enabling that pace.
And sticking with financial discipline, their working capital looks really stable.
Yeah, net working capital days. That metric of how efficiently they use cash in operations, it held steady at 60 days, comparing September 25 to September 24.
Inventory turns also stable, around 3.8 times.
So why is stable NWC at 60 days a big deal right now?
Well, think about it. They're growing revenue double digits. Online is exploding at 50%. They're opening scores of new stores. Often that kind of rapid growth makes working capital balloon. Inventory piles up, customer payments lag.
Right, cash gets tied up.
But the fact NWC days stayed flat at 60 suggests their operations are handling the growth really efficiently. It actually reinforces that point about better inventory control through direct channels.
They did mention slightly higher inventory days, specifically in Q2.
Yeah, they said that was due to stocking up early for the festive season.
But crucially, they managed it so it didn't actually increase the overall net working capital days. So good logistics, good planning there, efficient management.
And management seems positive about the broader economy helping them out too. The MD and CEO, Amisha Jain, mentioned expecting recent GST reforms to further boost consumer confidence and spending.
A rising tide helps, for sure, especially when you're targeting 12–15% growth.
But they're also realistic, which is good. They flagged potential headwinds in the presentation.
Like what?
Things like, quote, prolonged and intense weather conditions likely to affect demand in certain parts of the country.
Ah, yeah. Fashion is very seasonal. A long monsoon or a harsh winter can definitely impact sales. Always a risk.
But it seems their strategy to counter that is just keep investing in the brand, keep pushing for market share.
Their stated plan is continued investments in advertisement to drive market share gains. So even if the overall market dips temporarily due to weather, they aim to steal share from competitors.
And that investment in brand perception, in advertising, it supports the whole premium idea, right?
Exactly. It helps justify the price point, reduces the need for heavy discounting, and reinforces that whole gross margin improvement story. It's all connected.
Okay, let's look ahead then. Section 4. The investor's view and what they're aiming for in FY26, plus some brand specifics.
So the main goal for the full year, 12–15% revenue growth, and importantly, continued margin expansion.
Driven by what they call operating leverage.
Right. Operating leverage. Maybe we should quickly unpack that too, for someone not living this daily.
Good idea. What does it mean for a company like AFL?
Well, think about their costs. Some costs, like designing a new collection, or their head office rent, or executive salaries, they don't change much whether they sell 10,000 jeans or 100,000 jeans. They're relatively fixed. So when revenue grows, especially through high-margin channels like their own website, those fixed costs get spread over way more sales. Each rupee of extra revenue contributes more to profit.
So the profit grows faster than the revenue, proportionally.
That's it. That's operating leverage kicking in. It's the financial reward you get for achieving scale efficiently.
Let's make this growth more concrete. Look at specific brands. Arrow, for instance.
What are they highlighting there?
Big new celeb campaign, Vidang Raina and Kushi Kapoor. Investing in visibility.
Marketing push, yeah. But probably product, too.
Definitely. They mentioned product innovation, like auto press with FLX and 4.0. Sounds high-tech for a shirt.
Right. Focus on differentiation. It's not just any shirt. It's a special, maybe wrinkle-free, flexible shirt that lets them charge more, avoid those discounts again, supports the premium positioning.
And Flying Machine, another key brand, its direct channel growth was boosted by that early festive season timing. And the presentation connects it to the premiumization trend, helping brand deliver industry-leading sell-throughs.
Okay, sell-throughs. That's another important metric on the ground level.
What does it tell us?
High sell-through means the product is actually selling quickly once it hits the shelves or the website. They're not getting stuck with lots of unsold inventory at the end of the season.
Which they'd then have to mark down heavily.
Exactly. So high sell-throughs are direct proof that the strategy of lower discounting is working. Customers are buying it closer to the full price because they want the premium product.
Got it. And just a technical note, the board approved all these numbers after a limited review by their auditors, Deloitte, Haskins, and Sells. So the due diligence checks out.
Good to note. So if we synthesize this whole deep dive, AFL's Q2 performance really feels like a case study in sharp strategic execution.
How so?
They identified that the old wholesale model wasn't delivering the profitability they wanted. So they made a clear, disciplined pivot
Towards their own direct channels, the physical stores, and especially that booming online B2C.
Right. And crucially, they backed it up with operational discipline, keeping that working capital tight.
And the result, less need for discounting.
Which translated directly into that fantastic gross margin expansion, 210 basis points. And that flowed down to the 80 basis point improvement in EBITDA margin.
The path forward seems pretty clearly laid out, too. Aiming for that 12–15% revenue growth for the full year.
Powered largely by more store openings via that asset-light FOFO model and keeping the foot on the gas for their own online channel, which is already growing over 50%.
They want that direct channel share of the pie to grow even more, right? Another 100–200 basis points this year.
That's the target mentioned. If they hit that, given the higher margins in direct, the overall profitability picture should continue to strengthen.
Which brings us to our final provocative thought for you, the listener, as you watch AFL going forward.
They've clearly shown they can execute the strategy to expand gross margins by controlling channels and reducing discounts. They have the asset-light expansion model with FOFO, and their working capital cycle seems stable at 60 days.
So the question is, will this successful strategic shift and operational control translate into even bigger jumps in things like free cash flow generation and return on capital employed? Will we see those metrics accelerate significantly?
Or will those external factors they mentioned, potential demands, slowdowns, maybe those weather issues they flagged, force them to compromise on that pricing discipline later in the year to keep volumes moving?
It really comes down to whether they can maintain those strong sell-through rates and keep pushing that direct channel mix upwards. Definitely one to keep tracking.
Absolutely. Thanks for diving in with us today.